about mutual funds. But first, what is mutual funds? A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and debt. The combined holdings of mutual funds are known as its portfolio. Investors buy shares in mutual funds. Each share represents an investor part ownership in the fund and income it generates. Why am I discussing mutual funds? First, to have an investment. And then second, I want my money to grow. And the third is I want my future to be financially stable. There are benefits and risks of mutual funds. First is the dividend payments.
Dividend payments. A fund may earn income from dividends on stock or interest on bonds. The fund then pays the shareholders nearly all the income less expenses.
Next is the capital gains distribution.
Capital gains distributions. The price of the securities in a fund may increase. When a fund sells a security that has increased in price, the fund has a capital gain. At the end of the year, the fund distributes these capital gains minus any capital losses to investors.
Increase NAV.
Increased NAV or net asset value. This NAV represents the price at which investors can buy or sell units of the fund. When the value of the securities in the fund increases, the NAV increases. And when the value of the securities in the fund decreases, the NAV decreases.
There are types of mutual funds. Stock funds.
Stock funds invest in corporate stocks. Not all stocks funds are the same. Some examples are: first is growth funds. It focuses on stocks that may not pay a regular dividend but have potential for above average financial gains. And the second is income funds. Invest in stocks that pay regular dividends. And the third is index funds. It tracks a particular market index such as the Standard and Poor's 500 index. And lastly, sector funds. It specializes in a particular industry segment.
Bond funds.
Bond funds have higher risk than money market funds because they typically aim to produce higher returns. There are many different types of bonds. The risks and rewards of bond funds can vary dramatically.
Target date funds.
Target date funds hold a mix of stocks, bonds, and other investments. Over time, the mix gradually shifts according to the fund's strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind.
Money market funds.
Money market funds have relatively low risk. By law, they can invest only in certain high quality short term investment issued by US corporations and federal and state and local governments.
How to avoid fraud.
Avoiding fraud. By law, each mutual fund is required to file a prospectus and regular shareholder reports with the SEC. Before you be sure to read the prospectus and the required shareholder reports. Additionally, the investment portfolios of mutual funds are managed by separate entities known as investment advisors that are registered with the SEC. And guys, always check the investment advisor is registered before investing.
this is where my vlog ends.